Hey everyone, welcome back to Corporate Decoder, the place where we break down the numbers, but do they hold up under scrutiny? Today we are diving into a prospectus supplement from Blackstone Private Credit Fund about their recent note offering. It is packed with details that we will simplify for you. So Blackstone Private Credit Fund is looking to raise a cool $400 million by selling notes due in 2029. This is not exactly new territory for them. They already issued $500 million of these notes earlier in 2024, meaning they are now looking to expand that offering. Essentially, they are taking on more debt to finance their operations and investments. These notes are going to pay 5.950% interest twice a year. The maturity date is the 16th of July 2029, meaning they have to pay back the full amount. Then this is what we call debt financing, and it is a common way for companies, especially those acting as business development companies or BDCs, to fund their activities. Blackstone is a large private credit firm, and like many in this space, they are raising capital to invest in loans and securities of private companies. They are aiming to generate income and a bit of capital appreciation. The company is basically a financial powerhouse leveraging its connection to Blackstone, a global investment giant, to source deals and provide operational expertise to the companies they lend to. Their strategy is focused on private US companies mostly originating loans like first lien senior secured and unitranche loans. They also invest in second lien and subordinated debt, and sometimes even in equity. Think of them as a lender to businesses that might not be big enough for traditional bank loans or are looking for more flexible financing. Now here is where it gets interesting regarding risk. These notes are unsecured. That means if things go south, the note holders are not backed by specific company assets. They are essentially relying on the general creditworthiness of Blackstone Private Credit Fund. They will rank equally with other unsecured debt, meaning they are not at the very back of the line, but they are below any secured debt the fund might have. They are also structurally junior to debt held by their subsidiaries, which is a common structure in finance. Now let us look at the financial health of the company. Remember, this report is as of the 30th of September 2025 and the offering is happening in December 2025. Looking at the capitalization table as of the 30th of September 2025, the company had total assets of over $80 billion and total liabilities of about $33.6 billion. This gives them a net asset value of approximately $46.7 billion. Their debt load is substantial at over $31 billion, with a significant portion of that being secured debt and another large chunk being subsidiary debt, meaning it is structurally senior to these notes. This is a crucial section outlining what counts as an event of default. These are the trigger points that could lead to serious trouble for the company and its investors. Key events include not paying interest on time, not paying principal when it is due, and breaches of certain covenants. For instance, if they fail to meet a debt payment for 30 days, that is an event of default. Also, if they violate certain rules under the 1940 Act, and that violates the debt agreements, it could trigger a default. The company expects to net around $404.9 million from this offering, excluding accrued interest. They plan to use these funds for general corporate purposes, which primarily means investing in more loans and securities according to their strategy, and possibly also repaying some existing debt. This is typical for a fund like this, looking to grow its investment portfolio. From a tax perspective, they are treating this as a continuation of their existing notes. This means these new notes should be treated the same as the old ones for tax purposes, simplifying things for investors. The key takeaway here is that they are aiming to keep everything consistent between these new notes and the ones already out there. The whole underwriting process is being led by RBC Capital Markets LLC. They are the ones facilitating this sale to the public and will be offering these notes to investors. The underwriting agreement lays out the terms of sale and liability between the company and the underwriter. Now let us peer into the company's investments as of the 30th of September 2024. This is where we see where their money is actually going. They have a massive portfolio with investments across numerous industries. We see investments in companies like Atlas CC Acquisition Corp, with stakes in first lien debt. They also have significant investments in companies like Law Group Incorporated and Fastener Distribution Holdings LLC. The table shows the fair value of these investments and their percentage of the company's net assets. This is the core of their business, lending money to these companies and earning interest. The sheer number of investments hints at diversification, but also the complexity of managing such a large portfolio. Their total investments at fair value are just over $76.5 billion compared to a cost of over $77 billion. This slight difference indicates some unrealized appreciation, which is pretty standard in the debt market. The vast majority of their assets are in investments with over $2.1 billion in cash and cash equivalents to keep operations running. The liabilities are also substantial with over $33 billion, but the net assets are almost $47 billion, showing they are currently solvent. The entire filing includes pages and pages of portfolio companies and detailed financial breakdowns. Warren Buffett always says invest in what you understand. This filing covers a vast array of industries and sophisticated financial instruments like clause-collateralized loan obligations, investments where the company is essentially lending to a pool of other loans, making it quite complex. The sheer breadth suggests a strategy of diversification, but also a deep dive into specialized credit markets. So what is the story here? Blackstone Private Credit Fund is issuing more debt to expand its lending operations. They are a significant player in the private credit market, leveraging Blackstone's vast resources and expertise. The notes are unsecured, meaning there is risk, but the fund's overall size and asset coverage ratio suggest a level of financial stability. Their investment strategy is aggressive, focusing on originated loans to private US companies. However, the extensive risk factors section highlights the inherent dangers, including reliance on leverage market fluctuations and the potential for losses in their portfolio businesses. The huge list of portfolio companies shows a diversified approach across many sectors, but the complexity and the reliance on secure debt structures means investors need to do their homework. The company's substantial debt load also presents a potential risk, especially if interest rates continue to rise or the economy falters. For an investor in these notes, the key takeaway is that they are betting on the expertise of Blackstone's management to navigate these risks and generate sufficient returns to cover the interest payments and repay the principal. Alright, that is our decoder on Blackstone Private Credit Fund's latest offering. What are your thoughts on their strategy and the risks involved? Let us know in the comments if you found this breakdown helpful. Do give this video a like and subscribe for more corporate financial deep dives. We also have a community Discord linked in the description below where we discuss these kinds of filings and market trends daily. Thanks for watching, and we will see you in the next video.